First, the first transaction is I have something that is worth 100. I'm selling it for 20. I have a loss of 80. Now, I am then going out and spending 240 of cash to buy new equipment. But I did incur a loss on the first transaction because I'm selling something for 20 that's worth 100. From a bookkeeping perspective, I am debiting cash or increasing cash by 20. I am crediting the equipment or decreasing equipment by 100. The debit to expense or loss is what you need to make the journal entry balance if you're, if you're thinking in journal entry context. Now, under the combined transaction idea, okay, what the textbook author says is this. Hey, all I know is I am getting 20. I am spending 240. So mush the two together, combine the two. On a net basis, I am spending $220 worth of cash. Well, if I'm spending $220 worth of cash, the value of my system is going up by 220. And so under the combined approach, you would increase the value of your asset by 220. You would decrease cash by 220. You would think of it as one combined upgrade. There would not be a loss. Now, if you say, okay, but which one is appropriate? Is it appropriate to recognize a loss or not? The answer, and the textbook author, as is often the case with the textbook author, doesn't really delve into too much of a discussion of the reality of what happens. The accountant is supposed to sit down with the company and say, well, which one is it? I mean, is this really just an upgrading of the previous pipe? Or is the thing that I'm buying completely different from the thing that was there before? If what I am buying new is completely different than what was there before, then the two transaction approach is more reasonable. On the other hand, if what I am buying is really just a modest upgrade than what was there before, then the one transaction approach is more reasonable. There's the classic illustration. Let's say you have a hammer. You're a carpenter. You have a hammer. And the hammer is basically a stick of wood, which is the handle, and a piece of iron on top, which is the head. And that's all. There's only two pieces to the hammer. If the stick of wood breaks and then you replace it, and 1 year later, the head, the metal on top breaks and you replace it, is it the same hammer that you've had all along? Or is it a different hammer? Well, in a way, there's no single answer. It depends on how you look at it. In the real world, the way that an accountant would look at this thing, look at this choice, is to say, the more that the new system is completely different than the old system, the more likely I am to think of this as two different transactions. Otherwise, it's really a judgment call. Okay, questions about the quiz? I'm going once. I'm going twice. Well, I am delighted to say that we're 46 minutes into the class and we have finally finished our 5-question quiz from 2 days ago. Hooray. Thank you very much for your patience. I do appreciate it. What I will do is next week, we'll take another shot at having 2 different 5-question quizzes. Presumably, however, I'll be ready, for what happens for the first quiz, which will be the equity quiz that we took 2 days ago. I will have the questions on the screen from the get-go, from the very beginning of the quiz. And so if you took the quiz the first time around and you see that you're not allowed to retake it, it'll be right there on the screen. So you'll be able to jump right in and do what we did this time around. Taking that approach, I think if we take the equity quiz from 2 days ago and then take the new quiz, which will cover what I'm about to review with you, we should be able to be right on track or back on track by the end of the next session, Tuesday next week. Any questions about our plans there? Okay. Now, I do want to point out that if you go to Files, and if you click on Content Notes, that folder, and if you look at the Content Notes for Equity, instead of just saying, here is the link to the video that you watched for the equity quiz that we took 2 days ago, in theory. And then if you remember, I also said video link for the video for the last half of the chapter to be added. I actually went ahead and added the links for the new video for the material in the remainder of the chapter. However, Tuesday next week, we'll just cover the new chapter information that I'll cover for the first time beginning in a couple of minutes. And we'll also retake the equity quiz that was originally scheduled for 2 days ago. And I'll put this into my weekly messages that I'll write this weekend. Any questions, though, about our plans? Okay, so far, so good. Moving right along. Oh, Lawson, go right ahead.
Where was the second link posted, and are we supposed to watch that video before next week on Tuesday?
No. So the quiz we were supposed to take 2 days ago on equity was only the first half of the equity chapter, and there was one video for it. It was part A of equity. It's just that the handout, right, the content notes for chapter 18 equity said, here is the link for part A, and then it said, video links for part B and part C of the chapter to be added. We won't yet take our quiz for parts B and C of the chapter Tuesday of next week. We'll get part A done instead. But I just wanted to let you know the 2 links for parts B and C actually are there.
Okay, thank you.
Sure. Quick comment now. Please rest assured, we obviously have 4 weeks to go in the semester after today. So I'm not going to make any additional changes, certainly, to the way that we're conducting the class. I had mentioned Top Hat or other types of systems previously. And some of you have mentioned to me, well, there in other classes, when some of you have used Top Hat, there had been an incremental charge. The reason why teachers are tempted to go with Top Hat, actually, there are 2 reasons. Number one, there are things that should be simple, like me just saying, reopen the quiz for students who have begun it. And actually, that is what I did. But Canvas is just awkward and clunky, and sometimes you don't get information at all from Canvas about things like muted, well, exactly what some of you experienced a few minutes ago. And so out of frustration, some of us not being able to do what we want to do in Canvas and terribly missing Blackboard, which was the much better system that we used before we went to Canvas this semester. some of us do say, I'm going with Top Hat. However, there's actually other things that Top Hat allows teachers and students to do that I don't think any of you who actually used Top Hat in a previous class got to experience. Top Hat has, just as an example, a pretty nifty artificial intelligence program where a student can have a fairly helpful conversation with an artificial intelligence tutor. And the teacher, namely me, has all kinds of tools available to monitor the artificial intelligence program to make sure that the information being given is accurate and that AI is not hallucinating. Suffice it to say, there is, I mean, it will probably be years, if ever, before Canvas adds any kind of function like that. Most likely we'll never do it. But for services and functions like that, that's another reason to go, why someone might say, this might be worth looking at. So again, the bottom line is, don't worry, I'm not going to stop making changes and adopting new systems for this class. But I wanted to let you know that if we had been using Top Hat, all of the challenges and surprises that we just lived through would not have happened at all. And there are other really nifty, really helpful services that you may not have seen if you used it in a previous class, but that are there. So that's just a side comment. Last thing I wanted to mention, so what exactly happened to me 2 days ago? Pickup basketball game. I was playing with some people who were, I guess, half my age and twice as athletic. And I caught an elbow to my head, and my eye went black and blue and swollen. And I thought I was going to be okay, but apparently it didn't look too good from the perspective of the people that I was playing with. And I thought the best thing to do was to go into the urgent care center and make sure my eye is fine. And so I have quite the shiner, still a little bit of a swelling, but otherwise I am okay. And maybe I should in the future stick to my game. And I'm not quite sure what my game is, but clearly it is not basketball. So I'll try to keep that in mind. Thank you for all of your well wishes. I do appreciate it. And I'm glad to say that I'm quite all right at this point. Okay, so I think I'm ready to jump in and begin the next chapter. Any final questions about any of the odds and ends that that we've been experiencing? Okay, so finally, we have about 30 minutes to go. Let me go ahead and open Chapter 13, Liabilities. Okay. There we go. Chapter 13, Liabilities. So, Chapter 13, Current Liabilities. Let me simply move ahead and see how far we can get within Part A, which are current liabilities. My first illustration that I list on my content notes actually isn't an illustration. Rather, there is a section called Open Accounts and Notes. And I just wanted to cover with you some of these blue marginal definitions in the text. First of all, what is the difference between an account payable and a customer payable or a note payable, right? Or a current liability as in debt payable? Well, most importantly, the phrase that actually means something very specific. And so this is the one that I wanted to focus on. And I give the textbook author credit. This is the one that he focuses on as well, is the phrase accounts payable. Accounts payable are customer accounts, but the word customer is used broadly. So for instance, you are students to the university. If you owe tuition, you are considered customers of the university, and therefore your tuition payable would be an account payable. On the other hand, if I'm an employee of the university, and if I work, and if the university owes me wages, then that would not be considered an accounts payable. It would be wages payable, maybe salaries payable. I mean, there's different words that you could use, but because an employee is not a customer under any stretch of the imagination, you would never use the phrase accounts payable for wages or salaries due to employees. Similarly, if you're going into public accounting, you usually don't call your clients customers, you call them clients. And to honor that, you might actually have the phrase client fees payable in your general ledger. But because you are selling your services to your clients, even though the word client sounds nice and therefore you would use it, because you are selling stuff, you're a supplier of merchandise or services to your clients legally are customers, and therefore client fees payable are also considered accounts payable. Okay, any questions about that? Now you might say, okay, Mike, but it's really still just language, right? It's just words. Well, actually, under law, that's the law that governs contracts in every state. Accounts payable are covered under a different set of contract law than other types of payables. And so if your customer goes bankrupt, and if you say, uh-oh, I may not be able to collect my fees, the customer has now entered bankruptcy court. If the customer is actually a customer, and therefore, if what the customer owes you is actually an accounts payable, it's just a different type of court. It's a different area of the law, and therefore you need to be careful when you are using the phrase accounts payable than other types of payable. Okay, questions? Okay, otherwise, if there is a written note that you have to sign, basically a small contract, then you might use a word like note payable. If you have something like a credit card where the amount that you borrow goes up every time you buy something or withdraw money, and the amount of the loan, if you will, or the debt goes down every time you pay it down, for instance, then you're talking about a line of credit. If you owe interest, then you call it interest payable, etc., etc. These are all words. They're helpful, they're meaningful, but the only phrase that has real legal significance is accounts payable. Line of credit, it's just another comment, which is marginally helpful. If you have a line of credit, You do not have to sign a new loan agreement every time you want to borrow more money on it. And that's why they say you just use your credit card, which is a form of line of credit. Every time you make a purchase, you use the card. You don't have to sign another formal loan agreement. And I think this is, no, okay, we have a couple more definitions here in blue in the margin. If you see the word secured, if something is a secured loan, that means there is collateral. Now, most of us are most familiar with home mortgages, where your home itself is the collateral on the loan. But anything of value, anything at all, could be collateral, any asset. And if you have any kind of loan where there is collateral, we call it a secured loan because we say that the loan has been secured, or the lender feels more secure because there is valuable collateral to be collected or to be seized if the person does not pay up. And finally, what is commercial paper? It's a loan that has been designed to be sold. What does that mean? Well, if you go to your local bank here in the community and you take out a mortgage, you have a loan payable. The odds are very, very high that even though you might have a 30-year mortgage, that bank who lent you the money is not going to be the bank that you repay over the full 30-year period. At some point, and it's probably sooner rather than later, the bank that you borrowed from will sell your loan to a different bank or to a different investor. And then you'll get a letter from the new buyer of your loan that says, your loan is with me now. Pay me, don't pay your original bank. And by the way, before you start to send your money to the person who sent you that letter, go to your bank and make sure it's not a scam. Please, would be a good idea. And so what happens is if certain loans are sort of documented with the idea that the lender is going to go out and sell the loan to someone else, then we call that type of loan commercial paper. And it's usually corporate entities like banks that will do that kind of thing. Okay, and that's the conclusion of these blue marginal text comments and definitions on this webpage. Questions about that? Okay, next up, 13.6. So, I borrow money. This is a note with accrued interest. I borrow money, $700,000. I increase cash and asset by 700. I have to pay it back eventually. Increase payable by 700. 2 months go by. It's now the end of June. I say, wait a minute, don't I owe you interest? And the bank said, yeah, you're supposed to pay me $7,000 a month interest. Don't worry, you can pay me later. But 2 months have gone by, and you now owe, and this is just the interest on the note, $14,000. And so you increase the liability by $14,000. Increase the liability, that means you're reducing the value of the company. You record an expense. Well, 4 more months go by. Don't you owe more interest? Yeah, well, if after 2 months you owed $14,000 of interest, after 4 months you owe $28,000 more of interest. So at this point, you owe your total debt 700 plus 14 plus 28. And now you have to repay everything. Okay, the total amount of cash you're ever paying, 742. 700 plus 14 plus 28. You're repaying all of the liability. So whatever liability you previously recorded, you eliminate the liabilities because you're paying them off. So you eliminate or debit the original payable of 700, and you eliminate or debit the additional payable that you previously recorded. If you're thinking about this just mechanically or arithmetically, you could say, okay, to make the journal entry balance, I need to debit expense by 28,000. But does that make sense? Yes, it does. Because since the last time that you recorded interest, 4 months have passed. And because every month means you owe $7,000 more of interest, this should be 4 months of 7,000 or 28,000. And so you could record this as the number to make the journal entry balance, but it also makes sense that it is 4 months worth of interest because 4 months have passed between June 30th and November 1st. Okay, questions about illustration 13.6? Okay, next up, 13.8. This is actually, in my opinion, pretty straightforward, but the textbook author presents it in a way that makes it look complicated. So what's happening here? Well, I have 8,000 employees. They take vacation. If at the end of the year they have not taken vacation, I let them carry forward the vacation to the following year. Well, wait a minute. If I owe them vacation going into the following year, isn't that a liability? Because whenever I owe anybody anything, by definition, that's a liability. And the answer is, yeah, that makes perfect sense. Okay. Well then, 2,500 of my employees did not take any vacation, and therefore I owe them 2 weeks of vacation. Okay. 2,000 employees have not taken 1 week of their 2 weeks of vacation. And 3,500 employees have earned but not taken. Okay, I mean, it's an awkward column heading. Earned but not taken means they are carrying this forward to the new year, which means liability. I owe them something. What you see here is the total amount of vacation time I owe them. 2,500 times 0 plus 2,000 plus 1 times 1 plus 3,500 times 2. Number of employees times vacation carry forward that I owe them, total amount of my liability. That means that at the end of the year, I owe all of my employees a combined total of 9,000 vacation weeks. Each vacation week will cost me $600. That's how much my average employee earns a week. Okay, so if at the end of the year, I know that I will owe my employees 9,000 weeks of vacation, each one worth 600, then my vacation liability for carry forward of vacation days is 9,000 times 600, or 5.4 million. Increase or credit my liability for carried forward vacation time, 5.4 million. And if I increase the liability, it reduces the value of the company. That would be an expense. Okay, before I get back into this first journal entry, any questions about the second journal entry? Because the second journal entry is what the chapter is all about. It is a chapter about liability, and that is the journal entry to record the liability. What's the first the first journal entry all about? It has nothing to do with booking a liability. What the author is trying to say is, for these employees, if each of them could have taken 2 weeks vacation, and there's 8,000 of them, I could have been responsible for paying them for 16,000 weeks of vacation this year. They carried forward 9,000 of them. And so I actually paid them for 7,000 weeks of vacation this year. This is the journal entry that I record when they actually took vacation this year, and I paid them for it. And basically I say, just go take the time off. I'll still pay you cash. That's your salary. And I will record salaries expense. And so that's what this journal entry is. But again, it has nothing to do with the year-end liability, which is what this chapter is all about. Okay, questions about illustration 13.8. Okay, I'm hoping that what you are thinking is, this is not that terrible. Okay, not that terrible. Certainly easier, straightforward than many other topics that we have tackled together earlier in the semester. Okay, 13.9. It's on the next sheet. Refundable deposits. So I am selling something in containers. In addition to selling my customer the container, I say to my customer, by the way, I'm selling you the material in the container. I'm not selling you the container itself. I expect you to return the container. And to make sure that you return the container, you're going to have to pay me some cash, which is the container deposit upon delivery. You are buying whatever is in the container. But on top of that sales revenue, I am also going to make you give me $300,000 of cash on delivery. And when you finish using the material in the container, you'll have to return the container, which is mine, I'm not selling you that, to get the $300,000 back. Okay, so when you deliver the material, well, first, hopefully you debit cash and credit sales revenue, right? Profits for the material that you're selling. But then you say, I'm also collecting the container deposit from you. Increase cash for 300. Now hold it. Let's assume at this point that you do believe that the customer is going to return the container, and you do believe that you're going to have to give the $300,000 back. Then when you increase cash by 300, if you believe that you'll have to give it back to the customer upon return of the container, increase deposit refundable liability by the same 300. Now, let's say that the customer does return 90% of the containers, but not quite all of them. Okay, then you say to the customer, well, wait a minute. You returned 90% of these containers. You did not return quite all of them. I'm only going to give you 90% of your money back. Reduce cash by what you are paying them. 90% of what you collected, 270. Reduce liability by 270. And you tell the customer, I'm still holding on to $30,000 of your cash. If you give me the containers back, you'll get the 30,000. At the moment, you are still expecting the customer to give you back the remaining containers. You don't think the customer lost them. You think the customer just forgot to bring them. And so you still have, okay, their $30,000 in cash. You still, that you'll have to give back if the customer returns the remaining containers. There's still a $30,000 liability on your books. What happens then? The customer says, I lost the containers, the remaining ones, the $30,000 worth. I just lost them. Sorry about that. And, or maybe I broke them, and so they're not returnable. I broke them. Okay. You know that liability of $30,000? I no longer owe you that money. It's mine to keep. Debit or eliminate liability for $30,000. If you reduce a liability, you increase the value of the company, and that is revenue. Finally, if you had those containers on your books as your assets, because remember, you were always quite clear. I'm giving you these containers so that you can take what it is you're buying, but I'm not selling you the containers. They continue to be mine. Well, if those containers were still assets on your books, even though during that time they were sitting in your customer's warehouse, if you then are told that your customer destroyed your containers, you need to remove container inventory from your books. Credit or eliminate your container inventory that your customer destroyed or lost. Elimination of the value of an asset, or if asset value goes down, company goes down, company value, that's an expense. Now, I know you're looking at the words cost of goods sold expense, and you don't see the word expense listed there. But if you do remember, in a much earlier chapter this semester, we did say that cost of goods sold is an expense. The bottom line, you collect a deposit from your customers, but at the moment you think you're going to have to repay it. Increase cash, increase liability. To the extent that the customer does return the containers that the deposits are on, then you eliminate liability, repay the cash to the customer, reduce cash. If the customer says, oops, whether I lost or destroyed those containers, I no longer have any right to expect you to return the last of the deposits, then you eliminate the liability from your books, increases the value of your company, that is revenue. And finally, if you say, yeah, but wait a minute, I was continuing to show that asset on my books, because even though my customer was holding on to that asset, it was still my asset. Well, then you have to eliminate the asset from your books because it's gone. Value of your company goes down, that's an expense. Okay, any questions about deposits, about illustration 13.9? And any questions at all about what we covered today in liabilities? I'm not even sure that this material is new. I think it's quite possible that you covered it even in principles of financial accounting, and quite possibly in frameworks. But it is in the syllabus. You know, it's required. It does have its own chapter. And so here we go through it again. I guess what I'm saying is, if you're thinking, it doesn't seem complicated, am I missing something? No, you're not. It's just, it's listed as a chapter to be covered by us. Okay, so guys, we have 7 minutes to go, but since this has been such a fun-filled, action-packed week for us, I think I'm just going to call it a day. I'll hang out and chat if anyone has any questions or comments in general, as I usually do. But thank you for hanging in there with me this week. I do appreciate it. Have a great weekend. And one way or the other, I will see you on Tuesday next week. We will take 2 quizzes. One, the wrap up of the equity quiz that we first scheduled for 2 days ago. And then we'll proceed to this quiz as well. Okay, and with that, class is dismissed. And with that, let me transition over and ask if anyone has any questions or comments or thoughts. And going on up, Imran, go right ahead.
Yes, sir. I just kind of had a comment on the